We've got with us on the show Erwin Saff, who is Chief Pan-Asia Strategist for BNP Paribas Securities, who joins us on the show from Hong Kong. Now, Erwin, to begin with, do you believe the markets, or rather markets like India, whether they will be hugely volatile in the next 3 months, or do you believe there is scope of a directional breakout, either up or down, and if so, what triggers at the macro level do you think could cause that?
Well, the word volatile or volatility is misused these days. I guess human beings don't like to talk about negatives, so when markets are collapsing, you always hear the expression, markets are volatile. But volatile just means markets go up and down, perhaps more than normal. I think that is a characteristic of the Indian market. It is a higher beta, it's a more volatile market. So yes, I mean, volatility will be higher, but in a risk-on scenario, investors should be increasing their risk exposure. And in a global portfolio, an easy way to increase your risk is to increase your weightings in the Chinese and Indian markets. You take on board more risk, but you get back more return. And these are the worst performing markets year on year in Asia. They offer the most gains over the next 6 months.
Now, Erwin, given that the interest rate cycle in India hasn't yet turned, we haven't started yet seeing interest rate cuts coming from the Reserve Bank of India, do you believe there is still some headroom for the equity markets to rally?
Yeah, well, again, I think in the markets there's too much focus on year-to-date performance and there's not enough focus on year-on-year or 12-month performance. Even though Indian markets have rallied, they collapsed by 40% before they rallied. So the Indian market is still down 17% versus a year ago. The Chinese market is down 12%. So there's plenty of room for these markets to continue to go up. They haven't even got back to where they were 12 months ago. And yet, you know, the economy's still growing, corporate earnings are still going to be moving to a higher level. And in general, I think the recovery in the global economy that we're seeing is sort of led by the US, but we have to remember that China and India are still a big part, around 40% of global growth. So we can't just focus on the US recovery only and ignore this other big part of the growth pie.
Afternoon, Erwin. I'm going to narrow it down to sector specifics. You've liked cyclicals and been cautious on the tech stocks. Has that view changed over the past few weeks?
Yeah, so normally we would include the technology sector within cyclicals, and we do in the case of North Asia. But in the case of India, because it's primarily the IT services sector, this tends to be a defensive sector. So last year when the Indian market was collapsing, the IT services sector, which essentially benefits from a lower Indian rupee, was a huge outperformer. And then as the market recovers, we see the Indian IT sector is underperforming. So we're sticking with that view. You know, we should focus on cyclicals, but in the case of India, that would be more industrials and commodity stocks rather than technology stocks.
And in light of the recent volatility, how have you changed your portfolio positions? You were holding Reliance Industries. Do you continue to maintain that in your portfolio?
You know, I have a list of top 15 large cap cyclical picks in Asia, and Reliance Industries is, I think, the most disliked stock on that list. And that is not only when I go to India and I talk to investors there, they all seem to hate it. It's also when I'm marketing internationally, it's really out of favor. And I know this company has probably done things to upset investors in the past, but it is one of the best quality cyclicals in Asia. You know, it has excellent assets. It is cheap. You know, it seems like an obvious place to go if you want to invest in the cyclical upswing that we're experiencing at the moment.
Right, Erwin, you also like some mid-cap steel companies in India. Do you continue to favor them?
Well, mid-caps is we focus on our call of cyclicals ahead of defensives, and this is consistent with a view with a rising stock market. But another way to look at a rising stock market is you get outperformance of mid-caps against large caps. So the sweet spot in markets in Asia at the moment is where you can combine mid-caps and cyclicals. So the case of the Indian steel companies is a good one because they are mid-caps, so they should outperform large caps. And also steel is a highly cyclical sector. And if anything, we've noticed that while there has been some return of interest to cyclicals, there is still a tendency by investors to avoid high beta cyclicals. So things like airlines, steel, petrochemicals, shipping, these high beta areas are being avoided. So the Indian steel sector still looks to be in a very good place in terms of where these stocks can go.
Now, Erwin, tell us two stocks that you like in India, be they large cap or mid cap.
So in India, our top large cap pick is Reliance Industries, which is very out of favour, but it's a very obvious way to play. It's a high quality cyclical company, good way to play the cyclical upswing. In mid caps, we would look at the aluminium and steel companies. So a company like Nalco, very high beta, mid cap cyclical would be our top pick amongst mid caps in India.
And if we were to talk a little bit about the global market data from Europe, it's been fairly inconsistent to negative. It's more indicative from the US. What could developed markets say or do over the next 3 months that could impact the Asian markets positively or negatively?
Right. I think all we need to see is the continuation of the existing trend in developed markets. So we've seen the PMIs globally all in a upward recovery trend. And this bodes well for the next 6 months in terms of economic performance. So the improvement in US economic performance, I think, is widely understood. And at this point, the US economy looks to be on track to deliver 2 to 3% growth this year, which is a far better result than what the markets were looking at 6 months ago. Now, as long as we're on track as long as we remain on track for 2 to 3% growth, we don't have too much to worry about here in Asia. I would expect US equity markets have maybe run ahead of other regions. So right now, when we look at the Dow Jones and the S&P 500, they're showing signs of starting to plateau. But as long as there's no big correction in those indices, there's a lot of room for Asian markets to catch up. The catch-up phase, I think, is not even halfway through. So over the next 6 months, we continue to expect Asian markets to outperform the US markets.
Erwin Saff, many thanks for coming in on the show and giving us your outlook for the Asia region, the global markets as well as India.